On IPO day, millions of investors are going to open their brokerage apps and see what may become the most anticipated public offering in modern market history. SpaceX, the company that lowered launch costs, the company building a global satellite internet network, the company that turned rockets into something that can land themselves. And if the early projections are correct, the company could debut at a valuation approaching $1.75 trillion. That's the exciting headline. Here's the less exciting one. Some of the best companies in history became terrible investments when investors paid too much. Back in 2004, many people thought buying Google after its IPO was reckless. The stock went on to create enormous wealth. But in 2012, investors said many of the exact same things about Facebook. Revolutionary company, massive growth, can't miss opportunity. The stock lost roughly half its value after going public before eventually recovering years later. Same excitement, very different experience. Because hype is not information, and a great company is not automatically a great investment, especially when everyone already knows it's great. That's why before you buy a single share of SpaceX, before the headlines convince you that this is a once-in-a-lifetime opportunity, before social media decides for you, we need to answer a much harder question. Not whether SpaceX is impressive. It is. The question is whether the stock can possibly justify the price investors are being asked to pay. Hey, I'm Brian, and I spend way too much time thinking about the gap between great businesses and great investments. In this video, we're going to break down the numbers, the incentives, the IPO mechanics, and the math almost nobody is talking about. And if you enjoy calm, evidence-based investing content that focuses on reality instead of hype, consider subscribing. Because what we're about to uncover has very little to do with rockets and everything to do with how money actually gets made in markets. And to understand that, we first need to separate the company from the stock. Let's get something out of the way immediately. This is not an anti-SpaceX video. In fact, the opposite. SpaceX may be one of the most remarkable businesses ever built. It transformed an industry many people thought was impossible to disrupt. It created an entirely new global communications network through Starlink. And it continues to push technological boundaries that competitors are still trying to catch. None of that is in dispute. But this video isn't really about SpaceX. It's about something different, and in a way more important, the difference between a great company and a great investment at a given price on a given day. Those are not the same thing. A Ferrari is an incredible car. That doesn't mean you'd pay 10 times its value. A house can be beautiful. That doesn't mean every price is reasonable. The same logic applies to stocks. And once you understand that distinction, the rest of this story starts to look very different. So let's walk through exactly what we're going to test. Here's where we're going. First, we're going to look at the machine behind every major IPO and why retail investors start the race from behind before trading even begins. Then we're going to open up the hood and examine where SpaceX actually makes money, because the answer is probably not where most people think. After that, we'll look at the valuation itself and compare what investors are paying to what the business currently produces. Then we'll examine who really benefits from the famous first-day IPO pop. We'll look at the hidden forces that can temporarily push prices higher after the listing. And finally, we'll ask the one question that matters more than everything else combined. What would SpaceX actually have to achieve from here just to match a boring index fund? But before we talk about valuation, you need to understand the machine. Because the machine explains why so many investors end up buying great stories at terrible prices. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Imagine a massive stadium hosting the most anticipated event of the year. There are front row seats, there are middle seats, and there are seats all the way at the back. Now imagine the tickets are being handed out before the doors open. Who gets the front row? The biggest institutions, pension funds, mutual funds, large investment firms, the investors with relationships, influence, and billions of dollars to deploy. They get access first. Then come the professional money managers and favored clients. They're not in the front row, but they're still close enough to see everything clearly. And then, finally, after most of the best seats are gone, the doors open to everyone else. That's where retail investors enter. That's you. That's the average person opening an app on IPO day. Most people think the opening bell is the beginning of the race. It isn't. It's the final handoff. Think of an IPO like a relay race. The first runners are private investors who bought in years ago. The second runners are venture capital firms and institutional buyers. The third runners are large funds that receive allocations before trading starts. And by the time the baton reaches the public market, You're receiving it after multiple participants have already completed their laps. You're not standing at the starting line. You're standing near the finish line, paying a much higher price for the same ownership stake. And that's important because the opening price many investors see isn't the original price. It's already been shaped by a long chain of earlier transactions. The question is whether what's left is still attractive. To answer that, we need to look at the business itself. Because underneath all the rocket launches and headlines, there is a much simpler economic reality. Let's strip away the excitement and look at the actual engine. According to recent estimates, SpaceX generated approximately $18.7 billion in revenue during 2025. That sounds extraordinary, and it is. But revenue is not profit. Revenue is simply money coming in through the front door. What matters is how much stays behind after expenses leave through the back door. And this is where the story becomes more interesting. Despite generating nearly $19 billion in revenue, estimates suggest SpaceX lost roughly $4.9 billion overall. That means the company as a whole is still spending more money than it earns. But the losses aren't evenly distributed. One segment is carrying the entire organization. Starlink, the satellite internet business, generated approximately $11.4 billion in revenue, representing more than 60% of total company revenue. More importantly, Starlink reportedly generated roughly $4.4 billion in operating income. That's the profitable engine. That's the part creating meaningful economic value. The launch business, despite its technological success, operates with much thinner economics. Meanwhile, newer initiatives, including artificial intelligence and future development projects, continue consuming enormous amounts of capital, which creates a surprising reality. When most investors think they're buying rockets, they may actually be buying internet service. When you buy a share of SpaceX, you're really buying Starlink towing several heavier, money-losing cars behind it. The profitable engine is pulling the train. Everything else is along for the ride. Now that's not necessarily bad. Many great companies invest aggressively before future profits arrive. The problem appears when investors assume future success has already happened and price the stock accordingly. Because once we compare these business fundamentals to the valuation being proposed, the numbers become much harder to ignore. Now we arrive at the number that matters: $1.75 trillion. That's the valuation many investors may be asked to accept. And whenever you hear a number that large, the first question shouldn't be, can it get bigger? The first question should be, how did it get here? Less than a year ago, SpaceX was being valued at roughly $400 billion in private markets. Now the discussion has moved toward $1.75 trillion. That's an increase of more than 4 times in roughly 11 months. Think about that. The business did not become 4 times larger. Revenue did not quadruple. Profit did not quadruple. Yet the valuation exploded upward. This is where investors often confuse a better story with a better business. The story became bigger. The economics did not increase at the same pace. At a $1.75 trillion valuation and roughly $18.7 billion in annual revenue, investors are paying about $94 of valuation for every $1 of annual revenue. 94 to 1. For a company that is still losing money overall. That is an extraordinary multiple. Not just high, extraordinary. Now compare that to many mature technology companies, which often trade at a small fraction of that revenue multiple. The gap becomes difficult to justify without assuming years of near-perfect execution. Then there's another issue. Independent Wall Street research estimates have reportedly suggested values closer to $780 billion. That's still an enormous company, but it's also roughly 55% below the proposed IPO valuation. And then we reach the crown jewel test. Let's pretend Starlink is the only thing you care about. Value only the profitable engine. Even using aggressive assumptions, the value generated by Starlink alone covers only a fraction of the $1.75 trillion asking price. In other words, investors are not just paying for today's business. They're paying for tomorrow's success, the day after tomorrow's success, and several years beyond that. The future is already included in the price, and that's where things become dangerous. Because even if SpaceX executes brilliantly, investors still need the company to outperform expectations that are already extraordinarily high. And yet, despite everything we've discussed, there's a reason the stock could still surge immediately after it starts trading. That's what we'll examine next. And this is where many investors make a critical mistake. They see a stock jump 20%, 30%, maybe even 50% on its first day of trading and assume the market is confirming that it's a fantastic investment. But that's often not what's happening. Think back to the relay race. The baton starts with early private investors who bought shares years ago at dramatically lower prices. Then it moves to venture capital firms. Then to institutions receiving IPO allocations before the public gets access. Each runner has been carrying the baton at a lower cost basis than the person behind them. Now imagine the opening bell rings. The stock jumps. Financial media celebrates. Social media explodes. Retail investors rush in. The baton changes hands again. But notice what just happened. Company didn't suddenly become better. The factories didn't become more productive. The satellites didn't launch faster. The business itself may not have changed at all. Only the ownership changed. The first-day pop is often portrayed as proof of quality. In reality, it's frequently the sound of cheap shares becoming expensive shares. It's a transfer event, a handoff, a baton exchange. And the people benefiting most are often the investors who owned the stock before the excitement arrived. That's why the opening day surge can be so deceptive. It feels like evidence. It feels like validation. It feels like you're witnessing smart money discovering value. But in many cases, smart money discovered the value years earlier. What you're watching now is the final transaction, the final handoff, the final runner. And that's why one of the most dangerous phrases in investing is, "Look how much it's up already." Because the people who truly got in early aren't buying that surge. They're often selling into it. They didn't get in early. They got in last. And after that first wave of excitement, another force enters the market that most investors never notice. For a while, the stock may continue climbing. Not because the business suddenly improved. Not because new information appeared. But because a different machine switches on. Index funds. When a company becomes large enough to enter major indexes, passive funds don't have a choice. They must buy your retirement account, your pension fund, your target date fund. Millions of dollars flow automatically into indexes every day. And when a new company gets added, those funds have to purchase shares regardless of valuation. Think about that. Not because it's cheap, not because it's attractive, not because analysts love it, because the rules say they must. This creates an artificial source of demand, a temporary price floor, a new buyer who isn't negotiating. They're simply following instructions, and for a while that can support the stock. But then another force arrives, the lockup expiration. This is where things get interesting. Most insiders aren't allowed to sell immediately after the IPO. There's a waiting period, a lockup. Think of it like a giant dam holding back an enormous lake of shares. Behind the dam are founders, early employees, venture capital investors, private shareholders, millions upon millions of shares waiting on the other side. Then eventually the gates begin to open, not necessarily all at once, often in stages, waves, one release after another. And notice the timing. The first wave often arrives months after the IPO, exactly when the media excitement begins fading, exactly when fewer eager buyers are showing up every day, exactly when the countdown clock disappears. So you have a strange dynamic. Demand is cooling, supply is rising, and many of the people receiving unlocked shares are sitting on enormous gains. Some will hold, but many will diversify, many will sell, many will finally turn years of paper wealth into actual cash. And who is standing on the other side of those sales? Often retail investors still buying the story. In market language, that's called liquidity. In plain English, you're the buyer. More bluntly, you become exit liquidity. And historically, this matters more than most investors realize. A surprising percentage of high-profile IPOs eventually trade below their first-day lows once the excitement fades and supply normalizes. Which brings us to the only question that can cut through all of this noise. Not the headlines, not the hype, not the excitement, the math. Let's forget rockets for a moment. Forget Elon Musk. Forget the headlines. Forget everything except one question. If you buy SpaceX at a valuation of $1.75 trillion, what would the company have to achieve just to match the return of a simple index fund? Let's be generous. Assume an index fund returns 10% annually over the next decade. Historically, that's a reasonable long-term expectation. 10% per year for 10 years means your money roughly multiplies by 2.6 times. So if you invest at a $1.75 trillion valuation today, SpaceX would need to reach approximately $4.5 trillion 10 years from now, just to deliver a similar outcome. Not outperform, match. Now let's work backward. Suppose investors remain optimistic and continue valuing the company at a generous revenue multiple of 15 times sales a decade from now. That's already much higher than what many mature companies receive. To justify a $4.5 trillion valuation at 15 times revenue, SpaceX would need annual revenue of roughly $300 billion. Read that again, $300 billion. Not $18 billion, not $30 billion, not $50 billion, $300 billion. So how fast does revenue need to grow? Starting from roughly $18.7 billion today, and reaching $300 billion 10 years from now requires annual growth of approximately 41% every single year for an entire decade, every year, without interruption, without major setbacks, without meaningful execution failures. 41%. Now here's the uncomfortable part. Growing at 41% when you're a small startup is difficult. Growing at 41% when you're already generating nearly $20 billion annually is almost unheard of. The larger a company becomes, the harder growth gets. Every percentage point requires more customers, more infrastructure, more capital, more execution. History is filled with brilliant businesses. History is filled with dominant businesses. History is not filled with trillion-dollar companies maintaining 40+% annual growth for a decade. Almost no company at this scale has ever pulled that off, which leads to the real conclusion. The question isn't whether SpaceX is a great company. The question is whether the future already priced into the stock is realistic. Because at $1.75 trillion, you're not buying a great company at a fair price. You're paying upfront for a near miracle. And you only earn index fund-like returns if that miracle arrives almost exactly on schedule. That's a very different proposition than most investors think they're making. Which leaves you with three choices. The first path is the loud path. You buy immediately. You chase the headlines. You convince yourself that a great company automatically means a great investment. Maybe it works. Maybe it doesn't. But you're letting excitement make the decision. The second path is another loud path. You dismiss SpaceX forever. You decide the valuation is too high and refuse to ever look at it again. That's not much better. Because extraordinary companies can eventually grow into extraordinary valuations. Then there's the third path. The quiet path. The patient path. You wait. You let the market discover a price. You let the forced buying happen. You let the lockup waves pass. You let reality replace excitement. Not because you're scared. Because you're disciplined. And those are very different things. The most important lesson here has nothing to do with rockets, nothing to do with satellites, and nothing to do with SpaceX specifically. It's that the best companies in history did not require investors to buy them on day one. The business doesn't disappear next quarter. The opportunity doesn't evaporate next month. Reality eventually arrives. It always does. The countdown clock ends. The headlines move on. The excitement fades. And what's left is the actual business, priced by fundamentals instead of emotion. So if SpaceX truly becomes one of the defining companies of the next generation, you'll likely have years to participate. You do not need to win a race to the buy button. You need to make good decisions. That's a completely different game. And the investors who consistently win aren't usually the fastest. They're the ones willing to wait until the crowd stops shouting and the numbers start talking. If you enjoy this kind of evidence-based investing analysis, consider joining our community and subscribing for future videos. But whether you subscribe or not, keep this habit. Whenever you see the next can't-miss investment opportunity, don't ask, how great is the company? Ask, how much greatness is already included in the price? Because that's where the real investment decision begins.